We really appreciate it. We have an exciting presentation for you today, geared specifically to the tech sector. And you'll be hearing from my partner, Glenn Myers from Preston, Willis, and my longtime friend and associate, Bob Graham from WavePoint, who most of you know, I think. The slides will take about 30 minutes, roughly. We'll have 15 minutes for Q&A at the end, but feel free to type in the chat box any questions you have during the session. You see, you've all been muted at the moment. You'll be unmuted at the end for Q&A. But if you have any burning questions that you want me to interrupt the speakers with, or point of clarification, just type it in the chat box. I'll interrupt them during the 30-minute presentation. So, Glenn, over to you. Hello, Glenn. You there?
Over to Bob Graham, please.
Oh, sorry, over to Bob Graham. My mistake. Sorry about that. Bob, over to you.
You know, the competition's eating my lunch, or the cloud conversion is going to cost too much money, or et cetera, et cetera. Not ideal reasons for selling. And I often thought, well, a little bit of planning a couple of years ago would have gone a long way to prepare a company for sale. And it isn't just good enough to have a business plan anymore, et cetera, et cetera. You really have to benchmark yourself against your peers. And I live the benchmarking against your peers every day when I negotiate with buyers, because that's exactly what they're looking for. You know, how do these guys compare to their competitors? And so that's what you're going to hear more about today as we go forward. So a little bit on WavePoint. The ideal partnership we have with PWG is you would take advantage of their service to get prepared and spruce up your company, if you will. And then when it's time to sell, we would step back in and take you to market. So we're a full-service technology M&A firm. We mainly do sell side worldwide. We have 4 clients in Australia. We have 3 or 4 clients in the US. We have 3 or 4 clients in Canada. Our buyers are worldwide, typically American/Europe. We've sold Canadian companies to Australian companies, American companies to European companies, et cetera, et cetera. You're in our worldwide database of 21,000 tech companies, and that's how we find buyers and sellers and match them up, et cetera. So my day is full of talking to people, usually buyers, and frankly negotiating with them. And therefore, we're constantly in touch with current valuations, the positive points about my client that we're trying to sell, the perhaps not so positive points about my client we're trying to sell. And that's, in effect, what we're talking about today. So to end that one, quickly, the better prepared you are for the exit that eventually is going to come sooner or later for most companies, the more likely you are to get a, you know, as we call it, fourth quartile price. Okay. So next slide, please.
It's up there, Bob.
Thank you. So what are the 4 pillars that drive buyers? Well, we get into these all the time. What are they looking for? Obviously, they want a good deal. Most companies, including very large companies, have to do acquisitions to grow the business. They just can't grow fast enough organically. The larger a company becomes, the less nimble they become. They can't keep up with development internally. It's usually too slow, too late, over budget. Therefore, they have to buy, you know, great little or smaller companies. So what are they looking for? What are the 4 pillars? Well, primarily, they're looking for good people, because they always need good people. Now, good people means actually not just good technology people. More importantly, good subject matter expertise within the sector. Number 2, probably the biggest weakness, is a lack of sales and marketing, especially worldwide sales and marketing. And finally, management skills. And then 4th would be good technical skills. They're also looking for good clients. It doesn't necessarily have to be large enterprise. That's kind of good if you've got logos that everybody recognizes, but there's lots of firms that focus on the SMB and even the consumer market. But they're looking for a good client list, ideally worldwide. Evenly distributed revenues from major geographies of the world, recurring revenue from these clients, all on multi-year contracts. They're looking for good technology. Cloud is no longer a trend, SaaS, it's mainstream. We get buyers who say, don't even bring me a company that's not cloud SaaS, because our company has basically said we're only going to buy cloud SaaS going forward. Good technology also meaning current technology, not yesterday's, Visual Basic, Python. I hear everything, but obviously good current technology, and often the technology is a deal breaker. If you're on something that's not perceived to be current, chances are, say client server, usually the buyer will pass. And lastly but not last, good financials. I mean, recurring revenue from a cloud model. I chatted with someone the other day. They were at 72% of revenue was recurring revenue from a cloud model. Well, that's obviously going to produce tremendous EBITDA. And so good financials means not break even, not lack of growth, not EBITDA to come, and frankly, no longer a promise of the future. They want to see results now. Okay, next slide, Glenn. So I thought for today, in the little bit of time I have, I would just give you some current valuations. And what I've done is I've taken a software company, and to keep it simple, we'll just use $1 million. Now, what I'm going to share with you now is not for a value-added reseller. It's not for an IT services company. It's not for an MSP. It's for a software company where the IP is owned by the company. Yeah. So we negotiate all the time, and here's what we tell our clients that we sign up.
Revenue greater than 1 million.
We basically say that we're going to get you 1.5 times revenue. So let's take an example. Let's say a $2 million company, we're going to get them $3 million. Now, a couple of reasons we focus on a multiple of revenue. Buyers typically want to buy a multiple of EBITDA. Most of my clients don't have great EBITDA, but the marketplace, the software marketplace, focuses on multiples of revenue anyway. Now, that's a base price, and then there are variables. So, for example, if you have value enhancers, which the PWG program's all about, benchmarking you against your peers in 18, 20 different categories, so that you know your value enhancers versus your competition, it goes up. So we can get you more like 3 times revenue plus if you've got great value enhancers. Well, what are some value enhancers? Well, again, a benchmark in the industry today for software is revenue per employee of 150K. That's it. Revenue per employee in any industry is a great productivity number. And if you're above 150K, I remember the days I was at IBM, it was like $700,000 per employee. If recurring revenue is greater than 50% of revenue, if you're on cloud SaaS technology, pay-as-you-go versus enterprise license, etc. Those are some things that are going to give value enhancers, therefore your price is going to go up for selling. Now, value detractors, which will take your price down. Well, if you're on older technology, if you're in a very crowded space, like let's click supply chain or EDI, where the competition is basically discounting because there's too many people chasing the same piece of the pie. If your growth in your top line is less than 20% a year, your break even. Frankly, there's too many Canadian software companies. If you take away their SHRED grants, they actually don't have any profits. It's amazing to me how many companies, let's say their EBITDA is 300K, guess what? Their SHRED grants 300K. So that's kind of because of worldwide, the rest of the world isn't as generous with SHRED grants. That's kind of for a foreign buyer, which gets a fraction of that and doesn't get a check. That's a detractor. Those are some things. Location sometimes, I mean, how would I say it? Canada's fine, but I do have clients in Australia, and some people just don't want to go there yet. So that's a quick summary of where we are today. Revaluations, re-software, the market's off since 2008, but is slowly coming back. And there's certainly an upbeat in activity for M&A. But again, back to the point of this seminar, it's a lot easier to sell a company that's prepared to be sold, i.e. an exit strategy, by following a plan, like the PWG plan you're going to hear about, than it is to just let's go to market and do the best we can. Okay, Back to you, Glenn.
Thank you, Bob. It's Glenn Myers, partner with PWG. We're going to spend a few minutes talking about how to maximize your business value and look for some of the hidden value that's in your company. Quick note on PWG, we focus on 4 areas within companies that represent the lifestyle of a company. We're going to talk about one of them or 2 of them today, but the other 2 that are up there are entering new markets and increasing top-line revenue. And we have plans, processes, and programs in our company to help companies at any stage increase their revenue or enter new markets. Today we're going to talk about improving your asset value and getting you positioned for some kind of a liquidity event. And we're going to talk about value as being the ability of the business to dependably generate profit and revenue into the future. So we're not only going to take a look at what your value would be if we took traditional methods and did a multiple of trailing revenues or EBITDA, but we're also going to look at what the opportunities are in the future for your business. And your value is important whether you're buying or selling, but it's also important if you're building your business. You need to go and raise some more capital, or you need to do a reorganization. The higher the value, the better off you're going to be for any one of a number of activities that you might want to undertake within the company. We can show you how to improve your value and identify the triggers that are going to make a difference. And we do this with a 90-minute business value assessment where we determine what the transferable enterprise value of the business would be and what the potential value of the business could be, identify the gap, and identify the areas that you need to improve to shrink that gap, and also the red flags, which are the areas in the business that absolutely need to be corrected if you want to improve the value at all. So the red flags are hugely important, but we also identify areas that may be less important, but with some improvement would shrink the gap between the potential value of your company and the value that we assess at the beginning. We do this by looking at 18 value drivers. 9 of these are internal and 9 of them are external. We go through these and drill down on these through a series of questions. The first level being a fairly simple question, at least on the surface when you first read it, and a multiple choice answer. So it doesn't take a lot of preparation to go through the assessment. We look for only 2 numbers to put into the algorithm. We look for your total top line revenue and your EBITDA. We then go through the questions, and this is an example of a question around the goal, the barriers to entries. And the goal is having significant obstacles, obviously, to stop your competition, and you pick where you think you are, from it's nearly impossible down to almost anybody can get in. So we go through each of the questions, each of the value drivers with 1 question each, and get the answers logged into the system. The other thing we do is assign a normal trading range to a company within your industry. So we can use this for many industries, but this particular example in the top right is the information industry, which includes software, and we could break it down finer than that as well. And this shows us that the average EBITDA for companies in the information sector is 2.4 to 5.4 times, depending on whether it's, as it says here, a fire sale or whether there's a strategic buyer. And we look at the normalized range. We then, as I said, go through and answer 1 question for each of the 18 value drivers, and we create a value rating using the algorithm that shows what your value rating would be for your company. In the top right quarter of the screen, it shows this company has a rating of 74. In addition, it breaks it down between the 2 sectors of the operational drivers, either market or operational, and gives you your score in each of those. So this one shows that on the market side there's a rating of 67, but operationally it's a rating of 81. And we then use the algorithm to create the optimum value and the value gap. This all shows up on a dashboard that you can access at any time, and it shows you where you stand in the process. So the first box shows this one's a manufacturing example, shows the annual revenue, profits, the rating, and the enterprise value and the potential value. So it shows a value gap in the next box of $3 million against a $10 million potential value. The bottom left corner shows progress since this particular client started the operation. It shows that the rating has gone up 16 points, and the value has gone up 148% since we started the exercise. Bottom center shows us the critical drivers to that value, and we'll have a look at those in more detail in a second. And on the far right, it shows a couple of red flags, things that absolutely need to be corrected before the value of the company can be increased, and you can shrink that value gap. So this is the important thing we're looking at here. While we're on this slide, you notice across the top we have tabs that say Dashboard, Workbook, Tasks, Reports, and Vault. The system is organized along those tabs. Dashboard is what we were just looking at. The Workbook is a list of all the 18 drivers and tasks and questions that need to be answered down through 3 levels. So there's the first level is one question for each driver. The second level gets up to about 50 questions, and the third level is about another 140 questions. And as you drill down, the questions become more granular, and the tasks become laid out so you can complete them. There's a task tab, a reports tab, and a vault. And as you go through the system and you get down to the third level and you complete a task, you store the supporting documentation in the vault, so you end up with essentially a very complete data room. So if you are in the mood to be selling your company, or you're looking to buy another company, all the data that you need to support your position is included in the system, stored in the cloud in the data vault. This is another view of the same analysis. This gets down to looking at each of the market drivers and showing you the score in each one of those, and again the rating distribution. You can see where your business is weak and where it's strong. This is where you get down into looking at the value gap drivers. So each one of these 18 has a value associated with it, and you can see what would happen if you fixed the issues around the sales and marketing. You have the potential to pick up almost $2 million more in your valuation. Down to the margin advantage at the bottom is only going to generate, I can't see, but only going to generate about $100,000 for you. So you can determine, and we show you with a rating, where the high value tasks are. And this is the bang for the buck sorting of these things. So you can determine that if I undertake the market definition, it's going to generate $57,000 in value for me, which is one of the highest ones on this, based on what it's going to cost to fix the issue. The one below is it has a higher value gap, but the cost of getting there is going to be a lot higher than the market. So you can choose to undertake the tasks that are going to generate the most value for you first, or you can resort this in other ways and undertake tasks that perhaps meet some other strategy that you're working on first. You can choose whichever you want to do. You can also jump back and forth through the system, so you can complete right down to the third level some of the value driver questions and leave some of the other ones for later. So you can pick and choose which you want to work on first. The only real important thing is that the ones with red flags absolutely need to be fixed. When you look at the tasks, it also has a suggestion area. So it gives you the task, and it gives you some suggestions to fix the issue, and creates a to-do list for you and plugs it into a calendar with timing, so that it creates a workflow to get these things done. In a company, it might be something that's being worked on by the management team, so you can manage your team around these task lists and this workflow with a calendaring system and an internal email system to communicate back and forth. As Preston Willis works with clients, we also have access to this information. We can't change any of it, but we can monitor your progress and offer suggestions as you go through the task list to hopefully make sure you get it done efficiently, quickly, and to the best of our collective abilities. So we are there with you, monitoring it and communicating with you as you go through this. I mentioned earlier the vault. This is just an indication of what that would look like. This particular example shows the company growth driver and the revenue chart that's stored up in the vault, so you can access it, and anybody on the team can access that document and look at it and work with it as they need to. So that's a quick overview. What we would like to do is we have normally an assessment fee of about $750 to go through the first 18 value drivers, but in our relationship with Bob Graham, we are offering to do this assessment to the people that he introduces us to out of his database on a no-charge basis, take you through the 18 value drivers, and get that first look at your value gap, what your value would be versus what your potential value would be. So we're quite happy to do this for any of the people that are on this webinar, and at the end of the webinar, by probably end of day tomorrow, we can email you a link that allows you to get in, register for this activity. Bob MacBean, did you want to jump in, please?
Yeah, thanks very much, Glenn. So we'll open it up. I think, Michael, you're going to unmute, or you have unmuted people. Thanks, Michael. If there are any questions, you can either type them in, or just ask them. Are there any questions from anyone that's online now? To either speaker.
I've got a question. Good. Daniel, I've been listening with interest here, and Bob, when he started talking, sort of presented this sort of software company selling based on multiple. A lot of M&A companies focus on software. Talk about going into a buyer, going through the development team, and finding companies that are making a buy or build decision and making a strategic sale where the value isn't about multiples, but it's about the strategic positioning of their desire to get into the space, their desire to keep this technology out of the hands of competitors. And this isn't the approach that you're proposing today, and which is fine, obviously. But I'm curious about your thoughts on, the right way. What do you think of M&A companies that do present that strategic sale approach as the way for a software company to exit?
Bob Graham, did you hear that?
Yeah, well, I think there was some heavy keyboarding, Daniel, while you were speaking.
Oh, I'm sorry, that wasn't me, I assure you, but I guess everyone's off mute, so...
yeah, so if you're going to type in a question, just put yourself in mute for a moment if you're going to be typing in a question, and then take yourself off. Okay, yeah. Thanks. Yeah. Okay, but Bob?
I think, Daniel, I heard enough in between clicks to say, let me paraphrase the question. How do you go out and find the strategic buyer versus the many, many, many financial buyers? Is that correct?
Well, it is, or your thought. I mean, it seems that you're presenting the exit scenario for a software company through a financial buyer rather than a strategic. I'm curious about whether you think those that claim to be able to do this through a strategic buyer are going about it the wrong way, or misleading the software companies they're talking to.
No, I think I don't have a single client that doesn't want a strategic buyer. There's a very simple reason why they want a strategic buyer. Strategic buyer is going to be better for their staff, their people. It's going to be better for their customers. Frankly, not to be too crass, it's going to be a much, much better price. So all of my clients expect me to bring in a strategic buyer. So I'm Please say that's what I do, and I'm sure that's what every other M&A technology firm tries to do. I mean, if at the end you have to settle with, quote, a financial buyer, of which there's far too many of them out there, the venture capital firms, for example, are awful. The investment firms are awful. We know a lot of the bargain basement billies. One of them is a very major TSX-listed company, about $500 million in revenue. You probably know the company. They don't pay very much. They pay 3 to 4 times EBITDA. We don't spend any time with them. They're frankly a waste of time. So we always go after the strategic buyer. Your strategic buyer is typically going to be someone who, well, a lot of deals are done in the sector. So, for example, if it's a bigger player, gorilla in the sector, wants to buy you. I'll give you an example of a deal we did with, just to throw out the word OpenText, we sold the company to OpenText. That was a strategic deal. My client was very happy. The reason for that was OpenText did not have an e-learning offering. My client had an e-learning offering. OpenText's two biggest competitors, Documentum and IBM, both had e-learning offerings. So there was a strategic buy or a strategic acquisition to OpenText. So there's an example. Okay?
Yeah, no, that's a good answer. Thank you.
Any further questions or points of clarification? Anybody? Last chance to jump in and get some free advice. Okay, go on.
Bob Graham, I'd make one point to everybody.
Yeah.
We have worked out this free 18 key questions, 18 key categories. I'd highly recommend you take advantage of it. First of all, it's complimentary, it's free. You will automatically be benchmarked by that exercise against your peers in the sector. I mean, I know a lot of software companies who actually don't know some of the current ratios in the software sector, like $150,000 per full-time employee. And yes, you got to factor in the outsourcing to India and all that stuff into FTEs. But those are key numbers. Your EBITDA, your percentage of revenue that's recurring. You know, your shred grant is all your profit. You need to. Some people, you know, it needs to be. How would I say it? You have to look at that objectively in the light of day, and therefore, how healthy is your company? It's kind of like going to your doctor. And then you can just take that and say goodbye, and that's fine. We have no issue with that. But if you want to then go forward and say, well, I'm planning an exit when I'm, you know, on my 45th birthday or whatever, then you need to work, you know, do the plan, work the plan, and then we will literally guarantee you'll have a much better appearance to a strategic buyer. You'll have much better metrics that you focus on in your quarterly reviews and planning sessions, and you'll get a better exit.
I'd just like to reiterate, I think that's true. You know, there's managing your business and managing your asset. And most people, as they're growing their business, get to know how to manage their business and manage it well and have metrics for that. But there's a whole other set of metrics, sometimes complementary, sometimes different, for managing the asset. And if acquisitions are in your radar screen, if M&A is or an investment into your company, or you want to eventually sell out, then managing the value of that asset is critically important to you. So just to reiterate what Bob says.
This is Glenn Meyer. Somebody typed a question and says, do we need to find our buyer? And I think that Bob Graham would jump in and say, no, that's his job. He finds the buyer. So
that's right.
Yeah. If that was the question you were asking, then the answer to that is no. You just call Bob Graham.
Yeah. I mean, it's like anything else. You use an accountant to do something, you use your lawyer to do something. Well, when it's time to sell, you use an M&A advisor. And if you've got a plan, you know, a PWG plan to feed the M&A advisor like me, again, guaranteed you're going to have a better outcome. There's lots of buyers out there. We have no shortage of buyers for our clients. It's a matter of, as Daniel said, finding the strategic buyer from the 100 that come forward and say, hey, tell me more about this company, Bob. You know, you got to get it down to the 4 or 5 strategic buyers that are going to bid against each other to get you the best price and the best outcome for your people, your clients, etc. Not just the best price. So we do that. That's what we do.
Yeah. So thank you. Thanks to all of you for attending. You'll be receiving an email over the next day or so with links to this presentation, and questionnaire will be sent out to you. Feel free to give us some feedback. We're always trying to improve these sessions. Love to have your feedback. And anyone that wants to follow up, just let us know. Glenn and Bob, is there anything further you want to say?
No, just a quick comment. We also are going to give you a link to a couple of white papers on some M&A survey results and a discussion of transferable enterprise value. So have a look at those, and there'll also be a link to come into the complimentary assessment. And as Bob Graham said, please take advantage of it. We'd love to talk to you.
Great. So thank you for your time today, and thanks to you, Bob and Glenn.
Thanks, Bob.
Okay.
Thanks, everybody.
Thanks.
Okay, thank you.